Welcome to Cambridge House Live. I'm Bridgitte Anderson, and Eric Coffin joins me, the editor of HRA Advisories. Thanks very much for being here.
Thanks for having me, Bridgitte.
Let's start off with the downturn that we've seen in the markets.
Yes.
Where do you see things are at?
I think we're a lot closer to the end than the beginning. I mean, in the way stocks are trading, the way the sentiment indicators for most of the commodity markets are about as ugly as they can get. And I mean, normally, in my experience at least, bear markets tend to end with a whimper, not a bang. I mean, you run out of sellers essentially. And I think we're probably pretty close to that point because, I mean, the funds are out, a lot of retail's out. I mean, there's no spark, an obvious one to kind of turn things, but I don't think it gets a heck of a lot worse.
So that's the kind of signs that you look for when you're seeing where the bottom is.
Yeah, I mean, we've seen the volume come right down. You've seen insider transactions have gone up a lot. Like insiders are, the ratio of insider buying to selling is actually quite high. So I think it's actually at a record right now. Some of that's self-preservation, frankly,
right.
but still, not all of it. I mean, that indicator, the insider buying generally means more than insider selling in my experience. I mean, it's a good sentiment indicator. Really what we need, I mean, there's one or two things I follow that have made discoveries and gotten a lot of attention in the last month. I think we need a few more of those because I think we're back to the old school. I think we're back to what's going to turn the market around is going to be discoveries. It's not going to be suddenly all the metal prices go up 50% and everybody is lifted. I don't think that's going to happen.
So is this a downturn then, unlike others? And that's what I've been hearing from a number of different people, that it's a different situation now.
It feels much more severe. I just think that, you know, a lot of people have decided that and they may be right, that the super cycle in commodities, if it isn't over, it's basically going to go flatline. I think a lot of the money that came into this sector in the last 10 years, say, came in on the back of the commodity super cycle. It didn't come in because they were looking for commodity X. It didn't come in because they were looking for exploration stories. It came in because the expectation was, copper goes to $10 and gold goes to 5,000.
So the bad companies go up with the
everything goes up, and
right.
Everybody's right out of that mindset. You've had massive redemptions from the funds, so they had no choice but to sell. They're out, and I think we're back to the kind of market that we had in the 90s, 70s, 80s, 60s, where what turned things normally was someone making a discovery, a bunch of guys glomming onto that, and 50 companies or 100 companies attached themselves to this discovery and started doing exploration around it, an area play basically. I got a feeling that's what it's going to be again this time. It just feels to me like we're back to that kind of market. And
does that mean a longer term recovery then too?
Well, it does. I mean, one of the problems with the market right now for juniors is there's way too many of them. There's way too many of them. If you're going to add up all the CPCs, all that stuff, you're probably looking at 2,000 companies. There's maybe enough good management and good projects or good targets to go around for 600 or 700 companies, maybe.
Wow.
Like there aren't.
2/3 you think should.
They should. I don't think 2/3 will disappear. Yeah. I mean, one thing that's changed is that the exchanges in Canada, at least, they used to be almost like a utility. It's now a private company, so they have to declare quarterlies just like everybody else, and they've been going to pretty extreme lengths to kind of keep people listed and help them stay public, which is nice, I guess, at one level, get some listings fees, but there's a lot of deadwood. And when you think about the fact that there's, just use a round number, 1,000 too many companies, every one of those companies consumes $300,000, $400,000, $500,000 a year in audits and legal fees and office and all that stuff. And God bless the auditors and the lawyers, but I would rather see 1,000 times $200,000 or $300,000 or $400,000 go into the other 1,000 companies run by people that actually understand the business and know how to generate targets, and see that money ultimately go into the ground and find stuff. Those other 1,000 companies aren't doing anybody any good.
And do you think that there are jurisdictions that are hotter than others that investors should be keeping their eye on?
Yeah, I mean, Canada's always good because people are comfortable with it. I mean, Canada at a base level, there's areas where there's land claims to deal with. There's always areas where there's environmental permitting, but at a base level, I think it's fair to say Canada's pro-resources. It's a well understood system. People know how to get from A to B. You know, maybe they don't get the permits every time, but you know the process. Another place that I think is like that, it does have some issues with, you know, especially in the last decade with the drugs and stuff. There's some bad areas, but Mexico is the same way. They have, you know, it's basically a pearl mining place. They also have a very well structured system for getting concessions, doing work, getting permitting, getting environmental permitting. I mean, it's a well set up system. There's no surprises there. You know, they're not bending over. I mean, you have to follow the rules. But if you do, you're probably not going to get sideswiped as long as you deal with the locals. Plus, it's a place that has very good costs.
Right.
It's got good infrastructure. It's a fairly low cost place. So I think that area gets a lot of credit. There's areas in Eastern Europe is another place where I've actually picked up a couple of companies recently. I mean, those are relatively new jurisdictions. I mean, they came, you know, after the Soviet era ended. You know, there was a lot of shuffling there and country boundaries changed and stuff. But that's another area. It's not well known to Western investors because it was on the other side of the Iron Curtain. But there's some big swaths of one very, very good geology, but it's geology that has a lot of history of mining, so they understand the business. There are people over there that are quite skilled. And by and large, most of those countries are setting up, you know, regulatory systems and claim staking systems that are quite reasonable. I mean, you know, like places like Serbia, Bulgaria,
right.
Romania. I mean, they're all. I mean, most of those countries have. I think will probably get a lot more attention because the geology is very good. It's always known those were major mineral belts. They were just on the wrong side of the Iron Curtain for 50 years.
Let's get your thoughts on gold. It's been a big focus for investors, particularly over the last month or so. Where do you think gold is going in the near term?
Well, I mean, I wasn't, you know, even before what happened, I wouldn't say I was bearish, but I wasn't expecting anything that impressive on the upside. Partially because I seem to be less bearish about the U.S. than a lot of my compatriots, and you know, given that I think the U.S. economy is going to do okay, by extension, I thought the U.S. dollar was going to do okay, and gold trades against the dollar among other things. But it is also a wealth store, and it's a wealth-on thing in India, China, anywhere in Asia, really.
Right.
You're getting pretty strong physical demand since the price got knocked down. You know, I'm not a gold bug, so I don't see any conspiracies. I think it was just a trade. You know, the guys that were short saw a really good trade and they jumped on it. And it was. If you were short, it was a great trade. And I think most of those guys are out. I mean, I guess partially what I'm saying is I don't think it's like they're going to, you know, pound and pound and pound and pound. I think most of the guys that were shorting are out. They're done. They've moved on to whatever they're doing this month. I think it probably stabilizes in here. You know, my gut tells me that it probably gets some lift from here. The U.S. dollar looks a little bit toppy because it's gone up a lot, but more to the point, you know, the last week Ben Bernanke did congressional testimony, and the markets, the gold price, everything was just like all over the map. I mean, within 1 hour, everything was up 1%, down 2%. Everybody was trying to figure out what he was saying. Everybody that doesn't like gold all came out with these editorials the next day saying, oh, well, Bernanke was saying he's going to end stimulus fairly soon. That's not what I heard. I mean, what I heard him saying was, yes, they want to see better employment gains before they do that, but the other thing that he harped on was inflation, or rather lack of inflation. Right. Bernanke's a depression scholar, and anybody that looks at that period knows the one place you do not want to go is anything that smacks of deflation. You don't want to go there. It is very, very hard to get out of that once you get into it.
So what should investors take
So I think he might turn on the
then?
printing presses again. I
Oh,
mean,
really?
I think if he turns on the printing presses, it's not going to be because there's a kind of soft job report. It'll be because he keeps seeing that inflation gauge weakening. And I think that worries him way, you know, he is worried about unemployment, but I think he's way more worried about that. Because if you look at Japan, they got into one of those deflationary cycles. They're still trying to get out 20 years later. I mean, they're very hard to get out of.
Certainly a lot to watch for. Thanks very much for joining us, Eric. I really
you.
appreciate your time.
Thanks.